As you can hear, it can get quite noisy, and because this is a 2-hour lecture, I'll give you a 10-minute break during the middle of the lecture. So again, I'll put my hand up in order that you start. So once a few people start quietening down, other people tend to start quietening down as well. Now, what we're going to do today is, first of all, have a quick look at the course profile so that we have some understanding of what this course is about. So welcome to Money, Banking and Financial Markets 3 and 3D. So if you're here, I hope you're enrolled in that topic. And then I am going to give a lecture which is divided into 2 parts. So the first part of the lecture is just a brief recap of financial intermediation. And the second part of the lecture, we're going to look at how to interpret flow of funds statements, all right, because we want to have a look at the relative importance of direct and indirect finance, so the importance of financial intermediation in an economy, and we can do that by examining flow of funds statements. So that will be the second part of the lecture. All right, as I said, I'd like to start by having a look at the course profile. So if you have the course profile with you, just please have a look at that. Oh, I think I forgot to say that my name's Penny Neal, and so I better tell you a little bit about myself. Just please call me Penny. My details are available on the front page of the tutorial exercises handout, so you can see that there. You can see that the way the university works, they've put my full name for the email address, so you'll have to use Penelope for the email address. And I am a visiting lecturer here. I'm actually a full-time lecturer at Flinders University. So I'm not someone that has an office here in the School of Economics, but I have been teaching this topic for a number of years now. And in fact, way back, I used to be a full-time lecturer here for the School of Economics, but now I'm full-time down in the Flinders Business School at Flinders University. Unfortunately, that means I don't have an office here where you're going to be able to go and knock on the door and see me. And the other thing it means is that I'm only going to be available on Friday afternoons. So I'm going to have my student consultation time the hour immediately before this, so between 1 and 2 in Nexus 10, room 405. I will post that on my uni, so you'll be able to see that. All of the tutors that we're using for this course are casual tutors, so the same thing applies to them. They're not going to have an office where you can go and knock on the door, but they will all have a 1-hour consultation time. So between us, we will have 5 hours consultation times over the week. And even if a tutor's not your own tutor, you can go and see another tutor in the course if you have some problem. Barbara Rappaport is going to be the tutor in charge. But again, she's not like a full-time employee of the School of Economics. She's employed on a casual basis. So it's a little bit unfortunate for such a large class that we haven't got any full-time staff, but that's the School of Economics, not us as individuals. So I'm really sorry about that. But as I said, there are 5 of us involved in teaching the course, so there will be 5 consultation hours over the week, and I'll post the rooms and the times on my up on my uni on Monday. All right, so back to the course profile. And first of all, I just want to... some of you will have the Econ 3511 course profile, and some will have the Econ 7114 course profile. So we have more than 60 postgraduate students in this class, so the profiles will differ a little bit between the two. Yes?
Correct me if I'm wrong, but I looked on my uni this morning and the course profile wasn't on there at all.
The course profiles aren't on my uni. If you go to the front page of the university's website, and then click on the current students link, and then enter course profiles into the search box. Okay, you will find, you'll be sent to a page that says course profiles, and then you'll have to select the faculty of the professions, because economics is located in the faculty of the professions, and then econ for the course profiles. Yeah. All right, so the main reason from your perspective to have a look at the course profile is because it sets out the assessment. All right, I'm going to talk a little bit about that in a moment, but I first of all want to just have a look at the topic description. So where it says course description, which is be on page 2 for most of you, this course links the fields of macroeconomics and finance. It provides coverage of economic principles that underlie the operation of banks and other financial institutions. The role of money in the economy and the impact of monetary policy on the macroeconomy are examined, as are the links between monetary policy and the foreign exchange market. Now, in fact, that part of the description describes what we are going to do in this course, but I think the rest of the paragraph is more descriptive of what we do in this course. The course focuses on an understanding of the institutional environment in order to provide students with the ability to analyse contemporary issues facing those in financial markets, such as the subprime and global financial crises, currency crises, regulation of financial institutions, and inflation or deflation. It's not a course designed to further technical expertise in the instruments used in financial markets courses, okay, in financial markets. It's a course that was set up by the head, not the current head of School of Economics, but the head of School of Economics some years back, and he was finding that he was talking to students in financial markets topics, and they could, answer technical questions, but when he asked them anything about what was going on currently in financial markets, they had no idea. All right? So it was a course set up to sort of, in a sense, round your education in terms of financial markets to ensure that you've got some idea about what's going on. If you were to go out and be interviewed, most of the sort of job, like people interviewing you, your potential employers, they're not going to be asking, on the whole, very detailed technical questions. They're going to be asking you about contemporary issues in financial markets. All right? So if you're a student that wants, detailed technical knowledge to improve that, this is not the course for you. All right? It's quite descriptive, and it does deal with the issues that have been going on in financial markets that are, facing central banks and regulators and Bank for International Settlements and so on, all of those kinds of people over the last few years. So the most contemporary issue at the moment, of course, is the European debt crisis, and we will be looking at that later on in the semester. All right. So then going down the page, let me just find. Oh, I've got the wrong tutor in charge there. I was originally told that I was going to have a PhD student as a TA, so as I said, Barbara Rappaport is going to be the tutor in charge for this course. If you've got issues with respect to changing tutorials and those kinds of things, she's the person that you should email about that. All right, if we can move through the course profile and go to section 3, which is learning resources. Let's look at section 2 first of all, the course learning objectives. All right, so on completing this topic, students should be able to discuss the benefits of intermediated finance and interpret flow of funds matrices. Should be able to do that by today, or at least by the end of your next next week. Distinguish between the activities of commercial and investment banks, hedge funds and other managed funds. Analyse contemporary issues facing those in financial markets. Discuss monetary policy in the context of the international economy. Compare and contrast the views of different schools of thought with respect to the role of money in influencing economic outcomes. So those first 5 course learning objectives describe the material that we're going to cover over the course. And 6 demonstrate that they've worked with their peers to complete a small research project. One of the components of assessment is a group assignment, all right, and I'll talk about that in a minute. And then effectively communicate the knowledge gained in pursuit of the above objectives in verbal and written form. All right, now over to section 3, which is the learning resources and has the textbook. This is the textbook. All right, so this is what it looks like when you go down to uni books. All right, called Money, Banking and Financial Markets, 2nd edition. And in fact, it's a custom textbook that's been put together using different chapters from Pearson, which is a particular publisher. So I've tried to draw, chapters from different textbooks that are most relevant to the course that I teach. This is the second edition. I've already had a few emails saying, can we use the first edition? I would suggest not, all right? The reason that we've got a second edition is that nearly all of the original chapters have been updated. As I said, we're looking at contemporary issues in financial markets. And some chapters from the original edition have been dropped, and there's some extra material in here that's not in the first edition. All right, so this is the book that I want you to use. With this particular textbook, you're going to see that there are 2 page numbers on every page. All right, so one page number, there's a little box across the top, which, you're not going to be able to see from there, but there's a box across the top of each page with a page number in it. That refers to the page for this book. The other page is the page of the chapter in the original textbook. All right, so when I give you page references, it's the page that's from this book, so it's the page numbers that are in the box at the top of the pages in this book. All right, so just a warning, if you look at a page and think, this has got nothing to do with what the lecture was, last week, just make sure to check the other page and you'll find that that's probably the mistake that's been made. All right, so there's 2 pages. Unfortunately, it's the way that the publisher put the textbook together this year. That's a little bit unfortunate. They didn't do that in the previous book that they have this time round. All right, I will be recording the lectures, but I treat them as a backup, and nearly every year one lecture doesn't get recorded for some reason or other, like, there's a problem with the technology, or I think one year I forgot to upload. So if you come to me at the end of the lecture, and it's before I've uploaded the lecture, I might appear to be a little bit rude, but my first priority is to upload the lecture when the lecture's completed, so that everybody's got access to that. I don't want to get to the point where the icon disappears, or I can't upload for some other reason, or I forget because I've been talking to students for 40 minutes after the class. So, I will answer your questions, but sometimes I'm going to seem busy here first of all, and at the end of the lecture it's usually for that reason. All right, if you go to section 4.3 now, you'll see that there's an outline of the topics that we're going to cover. So week 1, financial structure and the flow of funds. And then from weeks 2 through to 6, we're going to be looking at banking and financial markets. So next week we look at the management of financial institutions. The week after, assessing the competitiveness of the Australian banking sector, because that's a very contemporary issue in Australia. Week 4, hedge funds, other managed funds and credit derivatives in particular. We're going to look at credit default swaps as a precursor to looking at securitisation and the subprime mortgage and global financial crises in week 5. You'll see there that the group assignment is due in week 5, so it's due the 29th of March. That assignment is already available on My Uni in the assignments folder, and it will be based on the material from next week's lecture. All right, so you'll have 2 weeks after the tutorial to prepare that assignment. Week 7, we're having a mid-semester examination, and that mid-semester exam will be in here. So it'll be during the lecture time, so at 2:10 p.m. on Friday the 27th of April, I think it is. And that week we won't have any tutorials. So in week 7 there will be no tutorials for 2 reasons. One is because there's an Anzac Day public holiday that week, but also because we've got the mid-semester exam, so you can use the time that you get for sitting the mid-semester exam. It'll be a 40-minute exam. It'll be 40 multiple choice questions in 40 minutes. All right, that's the nature of that mid-semester exam. And we won't have a lecture afterwards. So once you've sat the exam, you can all go. All right. Usually find the group's too restless to have a lecture after the exam. All right. So that's in week 7. So that's the second week after the mid-semester break. All right. So then we're going to have in week 8 9 and 10, we're looking at the international monetary system and monetary policy, and then money and the macroeconomy, so it's a little bit more macro-oriented. For the last 2 weeks of the semester, we look at money and inflation, and then schools of thought. Now, this course is a little bit of a difficult one to teach because we're not allowed to set prerequisites for it. All right, so there are some students in this class that have got no background at all. We sort of say assume knowledge is, financial markets and macro too, but there are quite a few students, particularly postgraduate students, that come into this class with no background at all. So sort of have to be aware that I have to teach assuming that some people are not going to have any background. And then go to section 5 and we'll have a look at the assessment summary. So the first component of assessment is the group assignment, which is due the 29th of March. And everybody, the postgraduate and undergraduate students are submitting the same assignment. So undergraduate students can work with postgraduate students in the same groups if they so choose. All right, that's permissible for the group assignment. And that has 10% of the course weighting for everybody. The mid-semester exam has 20% of the course weighting for everybody. Tutorial participation, 10% of the course assessment for everybody. And tutorial participation means just that. The School of Economics doesn't accept attendance as being indicative of participation. So we sort of go half and half. If you attend 10 tutorials and you don't contribute to the class discussion at all, the maximum mark you will get is 5 out of 10. All right? So participation means participation, preparing for the class in advance and contributing to the class discussion. So that mark is at your tutor's discretion, and you have to persuade your tutor at the end of the semester that you've participated in order to get the full 10 marks. But I've told the tutors it is for participation. It's not measuring how good you are. All right? So, participation can mean asking questions in class. Okay, that's one of the things that you should be able to do in tutorials. But it also means that you should be preparing for the tutorials in advance and making your notes. And then when you're in the tutorial group, you can add to your notes, based on the discussion that's going on in the classroom. All right, that's what. I will not be putting answers to tutorial questions up on my uni. All right, my expectation is that you prepare for the tutorials in advance of the tutorials and then you add to your own notes during the class discussion. All right. All right, now for the undergraduate students, the final exam will be worth 60% of the course weight. And the final exam's made up of a section which is just short answer questions, and it's also made up of essay questions. So it's a 2-hour exam, which is both a written exam and some compulsory short answer questions. For the postgraduate students only, there is a second assignment that will be due later on in semester. Okay, and that second assignment it'll be a written assignment, and again, it can be. Well, the first assignment for everybody is a group assignment. Everybody has to submit a group assignment, like participate in a group. For the second assignment for the postgraduate students, you can choose either to submit an individual assignment or a group assignment. That will be a written essay-style assignment. And that will be worth 10% of the course weight. So for the undergraduate students, the final exam is worth 60% of the total course weight. For the postgraduate students, the final exam is worth 50% of the course weight. All right. And I think that's probably all I need to say to you about the introductory matters. Any questions? No? All right. Well, then let's get on with the lecture. So today we're going to have a look, as I've said earlier, at financial structure and the flow of funds. And the first part of the lecture is, it's basically an overview of financial intermediation, so a very potted summary of financial intermediation as an introduction into the flow of funds. So from the custom text, as I said, there are some students in the class who will have no background at all, so they should read these introductory chapters. The students that had done finance and macro probably don't need to do it. Your why study money banking and financial markets, an overview of the financial system, and then everyone should be reading an economic analysis of financial structure and the saving and the flow of funds chapters. All right, so students without much background in financial markets, please read those 2 chapters at the top. So we're going to have a look before the break at direct versus indirect finance, a look at the advantages of financial intermediation, and touch very briefly on the principal agent problem. In the second half of the lecture, we're actually going to have quite a close look at a flow of funds statement and see how we can interpret that to determine how various sectors in the economy finance their activities, and also use the flow of funds statements to have a look at the relative importance of direct and indirect finance in the economy. That's quite an interesting exercise. One of the questions that I've set you in next week's tutorial is to compare the flow of funds statement for Australia just before the GFC really hit with the flow of funds statements that I'm going to have a look at today. All right? And so that's an interesting exercise in fact, how things have changed in terms of financing as a result of the GFC. All right? So we can actually look at how things have changed for various sectors in terms of their financing by examining the flow of funds statement. And as part of that half of the lecture, we're going to look at Mishkin's 8 basic facts about financial structure. So when you read the chapter, one of the Mishkin chapters in the custom text, you'll see that he lays out 8 basic facts. And the first 4 of them are to do with the importance of intermediated financing for the business sector. And in fact, it serves as a warning that what's going on in one country may not necessarily be going on in another country, and it also serves as a warning not to critically accept everything that's written in the textbooks. All right? So I'll talk about that a little bit later. All right. So first of all, when we talk about financial markets, it's sort of broad, all-encompassing term, if you like, and it's made up of various financial markets. So we can think of the banking market, which we're going to focus on quite a bit in this course, the stock market, debt markets, so markets in which various kinds of securities or bonds, if you like, are issued, and foreign exchange markets. So all of those go up to make financial markets. We've got various kinds of markets within the financial markets. And of course, within each of those markets, there are financial institutions. So in the banking market, for example, you've got commercial banks. You've got investment banks, which you might more properly want to include in debt markets and securities markets, but nevertheless, sometimes they undertake commercial banking activities as well, or they're part of commercial banking operations. So there are different kinds of finance. Obviously, in equity markets, you've got stockbrokers. So you've got stockbroking houses, for example, as an example of financial institution. Again, investment banks are often very involved both in trading activities and in assisting some of their clients to raise equity through initial public offerings and so on. All right. Thirdly, we've got financial instruments. So when we talk about financial instruments in financial markets, we're talking about claims of various kinds. All right. So in the banking market, if you place a deposit with a bank, the bank has a legal obligation to pay you that deposit, to repay you that deposit. So you've got a claim against the bank. All right. So in a sense, if a bank borrows some money by issuing a debt security or a bond into the financial market, then the investor who has purchased that bond or debt security, which is very often another bank or another financial institution, has a claim against the bank that issued the debt security. So particularly for those students here who haven't got much of a background in financial markets, issuers are institutions that are borrowing money, and investors are institutions or people that are actually lending money in one kind or another. So really important to make sure you understand that distinction between an issue of debt securities or an issue of equities. If a firm or a bank is making an issue of something, then it's trying to borrow some money or raise some money in some kind of way. If it's issuing equity, it's trying to raise money in some kind of way. Okay? If a bank or some other financial institution or a private company invests in something, then it's investing in a financial claim that enables it to obtain some money at like it's basically lending money and able to get the money back at some future date. All right, so in terms of the participants in financial markets, we've got savers, so they're people like you and I that basically put our money with the bank, or in America, a lot of people put their money into mutual funds rather than into commercial banks. Investors, all right, so investors are generally either individuals or corporations with larger amounts of money that can purchase debt securities or bonds. And, of course, we've got borrowers, all right? So, and that's the full gamut of participants in financial markets. So people like you and I might borrow some money, but, of course, small businesses want to borrow money. Large businesses might borrow money, but rather than going to the bank and taking out a loan like a small business, they probably issue a debt security or a bond into the financial markets and borrow money that way. Or a firm, of course, might issue equity into the financial markets. So the role of financial markets is basically to channel surplus funds or funds from surplus units, so that's savers and investors, so people who've got more money than they need at the current time, or companies that have got more money than they need at the current time, to deficit units or who are the borrowers. All right, so that's the basic role of financial markets. And if you think about that, that's a really important role in a modern economy because, of course, it means that there's a lot of more economic activity can go on, all right? So you just even imagine if all of us tend to place some monies on deposits with banks for at least a short period of time, all right? So even as depositors, we tend to be lenders for a short period of time, all right? What if every depositor suddenly decided that there was no commercial bank in the system? What are we going to do? Put it under our bed or in a money box or something like that? So can you imagine if there were no commercial banks into which we could place our deposits? Some of us might go around and try and find someone that we could lend some money to, okay, but we haven't got much expertise in that. And we might find someone that we know reasonably well and make that to whom we will make that loan. But most of us are more likely to just try and hide the money away somewhere, okay? What happens as a result of that? Lots of households, businesses don't get the loans that they need in order to undertake the economic activities that they want to do. So one of the principal advantages of a well-developed financial market is that it promotes economic efficiency through promoting economic activity. All right. And if you think about development of third world countries and the like, you will realise that one of the important stages in their development is generally the development of the financial markets. All right. It's generally the case that economic development in any major way goes along hand in hand with development of financial markets. And that's for this reason. It's that those people and corporations that have got excess funds for a period of time can lend those funds to people that actually want to undertake economic activity but don't have enough money at the current time to be able to do that without borrowing the money. So financial markets are very, very important. And you look at the most developed countries in the world, they're the ones with the most developed financial markets. Okay, that's not to say that they haven't developed so far, that they've had major problems in recent years. We know we're going to talk a little bit more about that later on in semester. But nevertheless, you think about all of the most developed economies in the world at the moment, what do their financial markets look like? They're all very well developed. And of course, another principal advantage of well-developed financial markets is that it increases consumer welfare. And that's basically because consumers, even people like you and I, when we're short of money, can have access to monies that we might need to pay a student loan or to purchase a car, to purchase a house, for example, or to finance some other activity. We're able to do that by borrowing money. in the way that we probably wouldn't be able to if we were just approaching individuals more directly. And we can spread out the payments. So if you think one of the advantages of a credit card is that you can, purchase a big ticket item. So, for example, a washing machine or something like that, which might be too expensive for you, like in one particular month, but you can spread the payments out, so increasing your consumer welfare through that kind of activity as well. All right. There's a very important distinction in financial markets, and that's between what we call direct finance and indirect finance. And indirect finance refers to finance that's provided with the aid of a financial intermediary, all right? So a financial intermediary is, like a commercial bank is a good example of a financial intermediary. It's an organisation that intermediates between the lender and the borrower, all right? So something that stands in between the lender and the borrower. In direct finance, there's no financial intermediary involved. And so in direct finance, there are basically two parties. In indirect finance, because of the financial intermediary, there are three parties. So a good example of direct finance is the stock market. Okay, if you purchase shares in a particular company through the stock market, then that company, or the management of that company, has got a obligation to try and use the monies that the shareholders have invested in the company as wisely as possible, and to try and generate reasonable return on equity so that the shareholders receive reasonable dividends and hopefully capital gains when they come to sell their shares. But the arrangement, in a sense, is just between you and the company. All right, you purchase a share in the company, and there's only, in a sense, one contractual arrangement. All right, that the company has the obligation to do its best by the shareholders. So it's just you, like the shareholders and the company. There's no financial intermediary standing in between. It may be that you purchase the shares through a stockbroker, but that's not a financial intermediary. All right? There's no contractual obligation between you and the stockbroker and the company in the way that there is with indirect finance. Indirect finance, as I said, involves three parties. It involves the borrower, the lender, and the financial intermediary. And the financial intermediary stands in the middle and intermediates between the borrowers and the lenders. So in terms of depositors at banks, all right, so we all place some monies on deposit at banks. Well, I imagine that we all do. All right, the commercial bank is the intermediary. What does it do with our deposits? It pools a very large number of money from small depositors and then lends them to some borrowers. All right, so there are two contractual arrangements there. One is that the commercial bank has the obligation to pay out your deposit. Okay, so there's a legal obligation between you and the commercial bank as a depositor. And as I said, the bank pools the monies from small depositors and makes larger loans to borrowers. And then, of course, there's a contractual arrangement between the bank and the borrower that the borrower repays the loan. All right. So in fact, that sort of idea of two contractual arrangements is the distinguishing characteristic of intermediated finance. There's a financial intermediary standing between the person that's got money to lend. So as depositors, we're lenders to the bank. And then the bank lends money to borrowers. So there's a financial intermediary, commercial bank, standing between the borrowers and the lenders. And, all right, so I'll leave that there. Oh, I don't know why I'm going. All right. So in the second half of the lecture, what we're actually going to do is actually look at the relative importance of direct and indirect finance in the economy. So in a sense, what we're going to do is have a look at the importance of, or relative importance or not, of financial intermediation in the Australian economy in 2010-11. That's what we're going to do in the second half of the lecture. These are some of the advantages of financial intermediation. So, of course, as small depositors, we could, if commercial banks weren't there, or if we chose, we could just lend monies directly to people. Like, you know, I could say, I've got a bit of spare cash, right, who wants to borrow some money from me? What's the problem with that? All right, one, that I don't know a single person in this class, so I've got no information about any of you, so I've got no idea about how good a credit risk you would be. So obviously financial institutions such as commercial banks and other deposit-taking institutions are quite large. They make loans to lots of people, all right, and lots of firms, so they've developed expertise in gathering information that tells them how good particular individuals or how good the credit risk is of particular firms, okay? They can sort of, you know, they're likely to ask you a series of questions through credit scoring regime, for example, income, employment history, where you live, you know, what other debts have you got, a whole lot of indicators that will give you some idea, give the bank some idea of how good a credit risk you are, all right? So banks have developed expertise in assessing loan applications, whereas individuals, you know, rather than putting my money in the bank, I could say to this class, oh, I'm going to lend you some money, but I have not got that expertise. I've got no knowledge about you, and because of that, I have got no idea even of your character, all right, in a sense, you know, whether you're just going to take the money and run or whether you would, you know, use the money in a suitable way. So one of the advantages of financial intermediation is that deposit-taking institutions have developed that expertise in assessing loan applicants for credit risk, which is the risk that the borrower might default on repayment of the loan. Okay, I haven't got that expertise. The banks have got that. Of course, a lot of banks are very large institutions, and in fact in Australia they have to be because they're required to hold quite a large capital base to operate as a commercial bank. So they've developed economies of scale, and you know they've got good IT systems on the whole that assist them in assessing loan applications. Another advantage of financial intermediation is because they gather monies from, you know, a large number of small depositors, they can provide liquidity services. So if you think about most of the liquidity services that are available in the economy, the payments mechanisms, they're nearly all, or not all of them, but a lot of them are provided through commercial banks, all right? So most of us access our funds through ATMs, for example, that are owned by various banks. Not all the ATMs are owned by banks, but most of them are. Most of the banks still provide checking services, although the Reserve Bank, there's been such a decline in the use of cheques that the Reserve Bank's looking into whether they should still be allowed to be used in Australia as a payments mechanism. But, you know, that's just being researched at the moment, that particular topic. So credit and debit cards, we're all familiar with that, you know, using our cards as EFTPOS cards and so on. So we've got this liquidity services that are available because we've got very quick 24/7 access to liquidity these days. All right. Again, the banks have got expertise in information gathering, so they've got various techniques that they use to assess loan applications. A very important aspect of financial intermediation is what we call maturity transformation. And if you think about the nature of commercial banking, what is it that the basic idea of commercial banking is that they take deposits and make loans. At its very simplest, that's what happens with a commercial bank. They take deposits and make loans. All right. Most depositors are small depositors, all right? So they're people like you and I who, as students, tend to be very poor, so don't have very large deposits. Even like somebody who's employed like me is going to have my salary deposited in a bank account, but, you know, it's not large in the scheme of things. So what commercial banks do is they take a large number of small deposits and then they make loans to a smaller number of, they make larger loans to a smaller number of borrowers. All right. Now, what do most of us want when we make a deposit? Interest. Is that the most important thing, do you think? Yeah. Money to be safe. The first thing most depositors want is to be sure that their bank is going to pay that money back. All right? And in fact, what we say is the deposits are capital guaranteed. That is, if you place your money in a commercial bank, so if you place $1,000 in a commercial bank, the bank will repay you that $1,000. And in fact, that's the most important thing as far as most depositors are concerned, is that their money is capital guaranteed. That is, that it's safe, that they will get the total amount that they paid back. Then most depositors would like interest, but in fact, if you're running a transactions account other than an online account, you're probably getting 0.1% interest. So interest is actually not all that important to many small depositors. What's also important, what's another aspect that's really important as far as depositors are concerned?
Ease of use.
Pardon?
Ease of use.
Years of use.
Ease of use.
Ease of use. Oh, right. Yeah. Okay. So the ability to be able to access money through ATMs without, travelling 20 miles or something like that. Another really important aspect, as far as most depositors are concerned, is that they can access their money very quickly. All right. They want liquidity. All right. So most people run transactions accounts where they might earn a very small amount of interest, but they know that they can access the money. They can run to their ATM today and get sort of $800 or $1,000 out. So most depositors are they're firstly concerned with safety, the capital guarantee of their deposits. Then they're concerned with liquidity, that they can access the deposits very quickly. And then they might be interested in interest. Some depositors will be interested in interest. But in fact, most depositors will place liquidity ahead of interest. And if you think about it, if you've got enough money to put in a term deposit, and most people will put some money in a transactions deposit that earns next to no interest before they put money in a term deposit. So that tells you that liquidity is more important than interest. All right. So in terms of maturity transformation, what we say about banks is that banks borrow short, all right, because most depositors are interested in liquidity. So a lot of money goes into transactions deposits, which are very liquid as deposits as far as the bank's concerned. All right, so we say that banks borrow short and they lend long. All right, most people who want loans aren't interested in repaying the loan tomorrow. All right. If they want a loan for a car, for example, they might be interested in repaying the loan in 5 or 6 years. If they take out a housing loan, they want to be able to repay the loan over a period of 20 to 30 years. So maturity transformation refers to the fact that banks borrow short and lend long. And in fact, that opens them up to quite a few risks on their balance sheet, which we'll talk a little bit about next week. All right. But from the perspective of us as individuals, that's great, all right? So, for example, I've got access to a transactions deposit. I also have a housing loan, all right? So, in fact, I'm a very good example of one of those borrowers who's deposited short, okay, because I want access to liquidity, but I've borrowed long because I don't want to repay my housing loan in 1 year's time. I would not be in a position to be able to do that. All right, so maturity transformation refers to the different terms to maturity on both sides of the balance sheet. So on the asset side of the balance sheet, the bank's got loans and they tend to be long-term. On the liability side of the balance sheet, the bank's got deposits, and lots of those deposits are very short-term. They're very liquid deposits in transactions accounts. All right, so that's a really important aspect of financial intermediation for most households and most firms, in fact. All right. The fact that our liquid deposits can be converted into long-term loans, and that happens as a result of financial intermediation. The last point I've got on that particular slide is asset transformation. And that basically refers to the different sort of characteristics that are associated with deposits and loans. Deposits are an asset from the perspective of us as depositors. We put the money in the bank, but we own our deposit, so it's an asset as far as we're concerned. So we tend to make small deposits that are very liquid. All right, what does the bank do? It turns them into loans, which are an asset from the perspective of the bank. Okay, they tend to be much larger, and they tend to be longer term. So asset transformation refers to the fact that financial intermediaries convert the assets of households, for example, so the deposits of you and I, that have a different set of risk, liquidity, term to maturity characteristics, but then they convert them into loans that, as I said, tend to be longer term, less liquid as far as the bank's concerned than our deposits are, and less risky than any individual loan that we could make. Now, of course, financial intermediaries such as banks are obviously making loans to large numbers of people. If I made a loan to a few of you, it would only be to a few of you because I don't have much surplus money. So at best, there would be 2 or 3 of you that would be borrowing money from me. But obviously, banks take monies from large number of depositors, so they can, and then they make loans to a large number of borrowers, so they can spread the risks. And it also means that they can not just spread the risks across a larger number of borrowers, they can also spread the risks across different kinds of activities that those borrowers are undertaking. So portfolio diversification, as far as the bank's concerned, is very important. Some of the bank failures back in the early 1990s were because banks didn't sufficiently diversify their loan portfolio. So in Australia, for example, we saw some of the banks concentrate most of their loans into commercial property. What happened? The commercial property market collapsed and then borrowers couldn't repay their loans. All right, so most commercial banks sort of diversify their loan portfolios more than that these days. And financial institutions reduce problems associated with asymmetric information. So asymmetric information means that whenever there's a transaction taking place, there are 2 parties, all right? So so in terms of a loan, there's a borrower and a lender. So one party to the transaction always has more information than the other party. All right, so if I lent you some money, you might tell me that you're going to use it to buy a car, all right? But in fact, you might race off down to the casino and gamble it all away, all right? So in borrowing lending transactions, it's nearly always the case that the borrower has more information about what's going to happen with the borrowed monies than does the lender. So that's asymmetric information, that both sides to the transaction don't have the same amount of information. And in banking, that can result from adverse selection and moral hazard. Just particularly want to talk about moral hazard here. That refers to the situation where one party has an incentive to act in a riskier way than the other party would like. So I've just given you one example between borrowers and lenders, all right? You tell me that you're going to buy a car. I think that's a good thing, okay? But in fact, you race off down to the casino and gamble the money, all right? So there's an example of moral hazard. I've lent you some money expecting that you will do something with it, but in fact, you've done something different. And that can happen, of course, with the banks as well. That borrowers to the banks go to the banks and say they're going to purchase, they're going to borrow money for a particular reason, and then use the money for some other reason. So a classic example there is someone going to the bank and saying they want to borrow money to buy a house that they're going to live in, like an owner-occupied house, and banks will actually lend money at reasonably low interest rates for owner-occupied housing. But instead of buying a house that they live in, they buy an investment property, all right? And that's a riskier proposition from the bank's perspective, and if the bank had known that the borrower was going to do that, then the bank would have charged a higher interest rate. So again, there's a moral hazard issue that the borrower might tell the bank that they're going to use the money for something different other than it's going to be used. Another example of moral hazard is banks and deposit insurance. So deposit insurance is where if the bank fails, the value of people's deposits get paid out to them by a deposit insurance agency or a regulator of some kind. And in fact, we have got deposit insurance now in Australia. Since the GFC, we've had deposit insurance in Australia. The problem, the moral hazard problem there is that if we didn't have deposit insurance in place, it may be the case that some depositors at least would monitor the activities that the bank's undertaking, okay? They would properly assess the riskiness of the activities that the bank's undertaking. When deposit insurance is in place, well, I don't need to do that. I know that if the bank fails, my deposit's going to be paid out. So whether the bank's undertaking risky activities and at greater risk of failure, I'm not going to care. So it's another example of moral hazard, okay? But in that case, it's where the regulators or the deposit insurance agency is not liking what the banks are doing. I'll just leave that for a minute. Some of the things that can address the issues that I've been talking about are monitoring, all right? And so one of the problems for me is if I make a direct loan to you, it's going to be hard for me to monitor what you do with the money. The banks are in a better position to monitor borrowers' activities. So if you think about business loans, for example, often the banks will require as a condition of making a business loan that the business provide its quarterly reports and so on. So the bank can actually monitor. And as depositors, what we're asking the bank to do is to take over that monitoring role. So one of the advantages of financial intermediation is that we know as depositors that the bank is going to use our deposits to make loans, all right? But the bank, rather than us as individuals, is going to monitor the activities of the borrowers. So one of the advantages of financial intermediation is that financial intermediaries take over the monitoring role that otherwise we would have to do if we were making direct loans. And so that's what I've got at the bottom of that slide there, that the financial institutions, rather than individuals, take over the monitoring. Another nice thing about financial intermediation is that most of that is in the form of debt contracts. So as I said, deposits are capital guaranteed. So the contract between you and the bank is that your money will be paid back, and usually with a specified amount of interest. They also, so that's where I mean, and if a borrower takes out a loan, there's the debt contract that specifies the repayment schedule and specifies the interest that the borrower's got to pay, and that repayment's got to be made regardless of whether the borrower has profited from the activities that they've used the borrowed monies for. When shares are issued, as shareholders, there's no guarantee that you're actually going to be repaid your investment. And in fact, some years back, I did purchase shares in a company which went belly up. And so I got zero return on my investment, okay? Whereas financial intermediaries, they issue debt contracts. When they make loans, they issue debt contracts that specify that a firm has to pay, whether it's profitable or unprofitable, and it has to make interest payments on that. So some of the solutions are requiring that the borrower has positive net worth, all right, from a business perspective, or collateral. Because those two things mean then that the borrower's got some assets that the lender can take over in the event that the repayments aren't being made. So the classic example there is most housing borrowers have to put up their house as collateral. So in the event that the housing borrower can't make loan repayments, then the bank can take over the house and sell that and recoup some of the borrowed monies that way. Monitoring and enforcement of what's called restrictive covenants. So restrictive covenants are conditions, so they're terms and conditions that are written into loan contracts. So for example, it may be that banks require firms to maintain their debt to equity ratios at certain levels. They're not allowed to become too highly leveraged, for example. And this third one here, I've said financial intermediaries retaining assets on balance sheet. That's because one of the problems that led to the subprime mortgage crisis was that banks made lots of loans to housing borrowers who were at high risk of defaulting on their loans, and then they securitised their loans. And when we talk about securitisation, what we mean is that the rights to the cash flows from the loans are sold to some other party, like the bank actually sells the rights to the cash flows from the loans to some other party. Well, what does that mean? That means the bank's no longer got an incentive to monitor the activities of the borrowers, or even to properly assess the credit risk of the borrowers. All right. So one of the things that's one of the current regulatory changes that's going on at the moment is that the banks have to retain at least a proportion of their securitised loans on their balance sheet. So they've got an incentive to properly assess the credit risk and an incentive to properly monitor the activities of the people to whom they've lent. All right. And I'll just finish this part of the lecture saying that when you look back through those advantages of financial intermediation, so, when you go away and reflecting next week on this lecture, it actually suggests that indirect finance might be quite important. All right. And so I've asked the question, is it? Okay. And the second question I've asked is, has the global financial crisis changed the relative importance of intermediated financing? In fact, that's the question I've asked you to look at for the tutorial. All right, we're going to look at the flow of funds statement for 2010-11. I've asked you for the TUTE to compare that with the 2007-2008 and say, well, has financial intermediation become more or less important? And as I've said at the bottom there, we can use flow of funds matrices to answer those questions and lots of other questions about financing in the economy. So that's what I'll do in the second part of the lecture, but we have a 10-minute break, so until 1:15.
Although I do business finance, but that didn't deal with institutional structure of the market. I was just technical stuff.
Yes. This course is almost the other way around. It's just physical rather than
What should have done with that commercial financial institutions for markets one, but so this textbook should be fine for my preliminary basic concept.
Yes, you can always look at the first few textbooks as a backup. You don't need to understand something. Then so we go back to that first few textbook backup. Okay. Before probably some reserve in the market for the first few students. So that's the thing is where you make sure things are getting older and sort of bring up.
Too loud, those look like familiar. Get these in the operating gym as well. And also this 1980, the US recession that I don't think is ever going to
There will be overlap, it's just
insurance and deregulations.
what they're doing. That foreign debt, that just as well. Is there a separation between the government and the university?
Yeah, we're going to talk about. I want to talk about it during the
I've just that figure that's a combination of these.
No, it's nothing to do. Well, some of these other sectors need to borrow some money, and some of them are coming from the international sector. It's a lot
Difference between equal roughly that.
Oh, I haven't looked at that. So, no, because these sectors aren't just borrowing from the foreign sectors, they're borrowing from other sectors within the domestic economy.
And then overall, even the difference between the lending and borrowing between, because obviously those four don't equal zero.
No.
Yeah, and that means we have to borrow from overseas at some point. So wouldn't that be that one? Is that what that whole thing is?
Yes, that is the amount we have to borrow from overseas.
And that's how much is obviously added to the foreign debt that we already have accumulated.
Yes, that's right.
Okay. And so is there a separate one for the government at all? Any kind? Or not? Because you know, like the whole budget deficit, like the surplus. Is there any way of knowing this?
We can get an indication of it. I'm going to go through this election. I'm ready to start again. Sorry, I'm losing my voice at the same time. All right, so for this second part of the lecture, we're actually going to have a look at the flow of funds statement. When you read the chapter in the custom text that's to do with the flow of funds statement, I don't want you to know, don't worry about how to go about constructing the flow of funds statement. I do want you to know how it's laid out, but the most important thing about the flow of funds statement is to look at it and determine how the various sectors fund their activities. All right? And we're going to look then at the relative importance of direct versus intermediated or indirect finance. So the first thing to notice about this flow of funds statement is, well, it's for 2010-11, so it's the latest full year flow of funds statement that we have in Australia. It's published by the Australian Bureau of Statistics. It's divided into two accounts. So the top account is called the capital account, and that looks at savings and investment of each sector. So it determines whether the sectors are in deficit or surplus. And then the financial account actually shows the way in which the various sectors have financed their activities or how they've invested their monies if they turn out to be surplus sectors. All right, so having a look at the sectors first of all. First of all, we've got non-financial corporations. That's the business sector. All right, so if you're looking at the way in which the business sector in Australia is financing its activities, you look at the non-financial corporations sector. All right, then we have financial corporations, so those are financial intermediaries. We have general government, self-explanatory, households and the rest of the world. All right, so the flow of funds statement is divided into those 5 sectors. All right. And then, having a look at the capital account, we can have a look at saving, and I'm just going to write some things on this to make it hopefully a little bit easier when you go away and have a look at. So this, in fact, here, this measure here is the savings measure for a particular sector. So we can see there that the business sector has actually saved $156.7 billion in that year. All right. But in terms of determining whether the sector is a net lender or a net borrowing, we have to look at savings less investment. And these items here are the investment items. And so, in fact, that adds up to $184.7 billion. So it's, in a sense, it's A minus B is equal to C, which is the net lending or borrowing requirement for the sector. And so, in fact, we can use the capital account to determine whether the sector was in surplus or deficit for the year. The flow of funds statements are published both for years, as this one is, so it's an annual flow of funds statement. They're also published on a quarterly basis in Australia, so you could also use the flow of funds to have a look at financing activities through a particular quarter if you wanted to. So savings less investment is equal to net lending or net borrowing, and we can see there that 156.7 minus 184.7 is equal to, in fact, a net borrowing requirement for the business sector of $28.1 billion. So the business sector, this figure tells us that the business sector was in deficit in 2010-11. That is, it needed to borrow money in order to finance. Well, it had to not necessarily borrow, it had to raise money in order to finance its activities. All right. So, and in fact, that's the usual case. It's usually the case that the business sector in Australia is a net borrower. All right, it's usually the case that the business sector is in deficit, so that's not unusual. If you add these things up, you're going to find there's minor discrepancies. You know, we're working in the billions of dollars, so there are going to be rounding errors and so on. So don't fuss about that. All right. So looking across the rows of the capital account, and that's what we're most interested in the capital account, is whether the sector is in a surplus sector or deficit sector. If it's a surplus sector, then it can lend money. If it's in deficit, then it's a net borrower. So the non-financial corporations or the business sector is in deficit. It's a negative figure there. So the business sector needs to borrow or raise monies in some kind of way, equivalent to $28.1 billion. All right, let's have a look at financial corporations. These are financial intermediaries. So it's an indication of the indirect finance that's going on in the economy. And we can see there that that's a positive number. So in fact, that tells us that financial corporations were a net lender, which is what we'd expect, particularly in Australia, given that, you know, they're largely commercial banks. And the financial corporations' net lending was $24.6 billion. All right. Now, having a look at the general government sector, we can see that general government, the figure for general government is negative. So that tells us that the government was a net borrower, okay, and that in fact the government was in deficit in 2010-11. So for those of you that have been doing macro over the last few years, or anybody who's been paying any attention to the news will know that the government's been in deficit for several years. All right, and so the government's been a net borrower, so that's not a surprise. Households, we can see there's a positive figure for households of $40.9 billion. So in fact, in 2010-11, the household sector was a net lender. And in fact, that's been a big change from like looking back 5 or 6 years ago. It used to be the case that households in Australia tended to be net borrowers. Now they tend to be net lenders. And again, if you've been paying any attention in the media, you will know that households have been, not spending money. Okay, the retail sales figures are showing us that on the whole, households are, not spending money, and they've been increasing their savings. So that's showing up in these flow of funds accounts, that households are now net savers. All right. Now, looking at the next row, so we've got net lending and net borrowing requirement. Looking at the next row, we can see we've got something called net errors and omissions, okay? And they're pretty big here, okay? $52.2 billion for the business sector, minus $47.7 billion for the financial corporations sector. The Australian Bureau of Statistics is a bit concerned about how large these items, like the net errors and omissions, have become in recent years, so they're doing some research into that at the moment. With statistical data of this nature, it's always going to be errors and omissions, all right? There's just problems with collecting data. You're collecting data on the whole business sector, you're collecting data from the whole financial corporation sector, so you can imagine that there are always going to be things that get left out, there are going to be errors that are made, but the size of them has become so large that the ABS has become a little bit concerned, well, more than a little bit, has become quite concerned about the size of them. So it is doing some research into that. However, they are by convention on the capital account rather than financial account, so we have to sort of take that into account, and I'll come back to those in a minute. Now, if we go down to the financial account is divided into two sections. So net acquisition of financial assets, so what assets did each sector acquire during the year, and net incurrence of liabilities. So how did each sector go about financing its activities during the year? If a particular sector borrowed some money, so if households borrowed monies, for example, then they're incurring liabilities in the sense that they're going to have to repay those borrowed monies. All right. If they put all their monies on deposit with the banks, then they've actually acquired a financial asset in the form of deposits. So the financial account is divided into these two sections, as I said, the net change in financial position and the net incurrence of liabilities. Now, the difference between those two, the net acquisition of financial assets less the net incurrence of liabilities, should equal the net lending or net borrowing requirement. All right, so we've got the capital account, we've got the financial account. In fact, the net lending or net borrowing requirement is should be, in theory, equal to the net change in financial position. So the net change in financial position is the net acquisition of financial assets. So if we call that D, so the value of the financial assets that each sector acquired during the year, less the net incurrence of liabilities, and if we call this F, the net change in financial position, that in fact the net change in financial position is equal to the net acquisition of financial assets minus the net incurrence of liabilities. All right. So as I said, in theory, if there were no net errors and omissions, the net lending or net borrowing requirement would equal the net change in financial position. So in theory, those two things, C and F, should be equal in theory. Okay. If you've got a net borrowing requirement, then that says that the liabilities that you've acquired during the period are greater than the financial assets that you've acquired during the period. But because of these net errors and omissions, we have to add, so I'll say C plus G is equal to F. But we can say here that in theory, C is equal to F, what I've called F there, the net change in financial position. All right, so from our perspective, what's important so far is each sector in surplus or deficit? So we've said, well, the business sector was in deficit, financial corporations were in surplus, government was in deficit, households were in surplus, and the rest of the world's in surplus. So in fact, it's that row from our perspective that's really important in terms of interpreting the flow of funds statement. All right, so now we need to sort of have a look at, I just want to keep this pretty well in the order. Let's have a look at the net change in financial position, net acquisition of financial assets for the business sector. So we'll just go through sector by sector and have a look at some of the main things that are happening in each of the sectors. All right, so we can see here that during the period, the business sector acquired a total of $95.7 billion worth of financial assets. All right, going down it helps to have a ruler here if you've got one, just so, particularly when you start working away on the other sectors. All right, so having a look down this column in the business sector, what are the principal financial assets that the business sector acquired? Well, I can see that the largest thing that the business sector acquired was equity. All right, so the main asset that the business sector acquired in 2010-11 was equity. There's $54.6 billion worth of equity, and that's the largest item out of the financial assets. All right, but there is another very large financial asset there, and it's currency and deposits. All right, so even the business sector was saving money to some extent, all right, through that 2010-11. Okay, so the major asset that the business sector acquired was equity, and the second one that was currency and deposits. All right, let's now go and have a look. We know that, in fact, the business sector, from up here, that the business sector was basically in deficit. Let's have a look at the liabilities that the business sector acquired during the period. Well, the biggest liability that the business sector acquired during the period was also equity. Okay, so what does that tell me? That tells me that the main way in which businesses financed their activities in 2010-11 was through the issue of shares. All right. So in 2010-11, the major way in which businesses financed their activities was through the issue of shares. The biggest liability that banks incurred was equity. And then if I go further up again, I can see that the second biggest liability that the business sector acquired were long-term securities other than shares. So these are debt securities. They're basically bonds that the bank has issued in order to borrow money. All right, so in the flow of funds statement, these long-term and short-term securities other than shares are debt securities. All right, debt securities are bonds. And so they're bonds that the business sector has issued in order to borrow money. So that's the second largest item in terms of the business sector's liabilities. So it mostly financed its activities by issuing shares or equity. But the second major way in which the business sector financed its activities was through the issue of long-term debt securities or bonds. All right. And you'll see that there's some negative items. That means, like the short-term debt securities, that means that the business sector's actually repaid some of its short-term debt securities through that period. Rather than issuing, it's actually repaid some. So that's what the negative items are referring. All right, now let's have a look at the financial corporations. So look at the financial assets of the financial corporations. What's the biggest item in the asset column here? Well, Yeah, by far, it's loans and placements. And surprise, surprise, I mean, financial intermediaries, financial corporations are financial intermediaries, largely commercial banks in Australia. What's the biggest asset that they've got? Loans and placements. All right, so the principal asset that financial intermediaries acquired were loans and placements. And the second major item there is currency and deposits. So the banks themselves will place money with other banks and with the Reserve Bank. All right, so that's the currency and deposits basically. All right, let's look at the major liabilities that the financial corporation sector incurred during the period. Well, guess what? Currency and deposits, and again, that's what we'd expect, right? Financial corporations are financial intermediaries. Okay, what's the biggest financial intermediary sector in Australia? It's commercial banks. What do commercial banks do? They take deposits and make loans. So the biggest liability that they've got are those deposits. All right, now having a look at the general government sector, and we can see, in fact, that there was very little error in terms of general government. So, in fact, we can see up here in the capital account that the government sector was a net borrower or in deficit for the period, and that the net change in financial position, there weren't any errors or omissions there. All right. So, in fact, for that sector, we can see that in practice, it's occurred in practice what should happen in theory, that the net lending or net borrowing requirement should equal the net change in financial position, and that's happened for the general government sector. All right, so what were the major assets that the general government acquired during the sector? Well, not very much by the look of it there. The biggest asset it acquired was loans and placements, and it's obviously paid out some monies there, all right, the negative figures, okay. If we've got a negative figure on an asset, it means that the government's paid out the figures. But we know, in fact, that the government was in deficit by quite a large amount, so it incurred some liabilities over that period. And when we look at the column here, we can see that the principal liability that the bank has, that the government's incurred are long-term securities other than shares. How does the government usually finance its budget deficit? Yeah, issuing government bonds. So that's what this is telling us, okay? The government's issued long-term government bonds. All right, and it's also obviously borrowed some monies, okay, because the second major item there is the loans and placements. All right, now looking at the household sector, the major asset that the household sector has acquired is insurance technical reserves. Guess what they are? Superannuation accounts. Okay, they're the money they're nearly all money in superannuation accounts. All right, so in fact, households are accumulating savings in a sense faster through their superannuation than through other methods at the moment. All right, so that's the major asset that households have acquired. And the second major asset are currency and deposits. They've placed deposits with the banks. All right, we see from up here that they're a net saver, and in fact the errors and omissions aren't very big for the household sector as well. So we can see that the net lending of the household sector is pretty well equal to the net change in financial position. It doesn't differ by too much. All right, so the second major way in which households acquired financial assets was through deposits. And looking down here, well, there's only one major liability that they've incurred, and that's loans and placements. So how do households finance most of their activities? They borrow money from the commercial banks. All right, okay. And of course, then we have the rest of the world. And we can see from up here that the rest of the world is a net lender to Australia. All right, so in fact, this figure here represents the addition to our foreign debt through 2010-11. So by how much the foreign debt increased through 2010-11. And because the rest of the world was a net lender to Australia, its net change in financial position was positive. That is, it acquired more financial assets than incurred financial liabilities. And again, we can see that the errors and omissions aren't very big for that sector. So the net lending is very close to the net change in financial position. All right, so having a look at the principal financial assets that the rest of the world acquired, Well, the big one here is that 68.5 long-term securities other than shares. So what the rest of the world did was purchase a lot of the long-term bonds that were issued in Australia. All right, so that's the major way in which the rest of the world lent to Australia, by purchasing long-term bonds that have been issued here. And the second major way is that $50.9 billion worth of equity. So the rest of the world purchased $50.9 billion worth of shares, basically, that had been issued by Australian companies. All right, what were the major liabilities that were incurred by the rest of the world? Well, the biggest item here is equity. All right, so can you get an idea that, you can see how various sectors finance their activities? We can look at the liabilities to see how the various sectors finance their activities, and we can look at the financial assets that each of the sectors acquired. All right, one of the other things that we wanted to do here was have a look at the relative importance of direct versus indirect finance, okay? Is direct finance more important in the Australian economy, or is indirect finance more important in the Australian economy? Well, indirect finance, to look at this, we actually look at the net acquisition of financial assets. So when we're considering the relative importance of direct versus indirect finance, we're going to be looking at this row, the net acquisition of financial assets, because if a sector is acquiring a financial asset, it's providing finance to other sectors in the economy. All right? So if a sector is acquiring a financial asset, it might be purchasing a bond, for example, then it's providing some monies to whoever's issued the bond. All right, so in terms of provision of finance, we can look at the net acquisition of financial assets. All right, so indirect finance is the net acquisition of financial... So I'll just write it here. Oh, sorry. Okay, so to measure indirect finance, we just look at the net acquisition of financial... the net acquisition of financial assets by financial corporations. Because financial corporations... So FA is financial assets, all right, as far as I'm concerned. Financial corporations are financial intermediaries, and so we just look at that row there, and we can see that the net acquisition of financial assets by financial intermediaries was $135.3 billion. All right, so we also want to measure the amount of direct finance that's going on in the economy in that year.
Could you zoom out?
Oh, sorry, yes, okay. I'll just zoom out a bit, yeah, so that we can see what's going on a bit. All right, I'll try and zoom back in a bit. Okay. All right, so to look at direct finance, what we have to do is we have to add up the net acquisition of financial assets by the other sectors and then take away the indirect finance. So it's the net acquisition of financial assets by non-financial corporations, which is 95.7. All right. Plus the general government. So it's still the net acquisition of financial assets in each case by the government. And that's minus 4.3. Plus the net acquisition of financial assets by households. And that's 127.6. Plus the net acquisition of financial assets by the rest of the world. And that was 106.2. And then we have to take away the net acquisition of financial assets by financial corporations. All right, so minus the net acquisition of financial assets by. And so that's minus 135.3. And that all works out to $189.9 billion. Now, some of you might be wondering why we took away the net acquisition of financial assets by financial corporations. That's so we don't double count. If you look at this, like the net acquisition of financial assets by households, what was the main financial asset that households acquired?
Deposits at bank.
Yeah, deposits at banks. And is that direct finance or indirect finance? It's indirect finance. It's financial intermediation. So that's why we take away the net acquisition of financial assets by financial corporations, because we're trying to measure direct finance. All right, so we don't need to double count. So when we measure direct finance, we add up the net acquisition of financial assets by non-financial corporations, general government, households, rest of the world, and then we subtract the net acquisition of financial assets by financial corporations. All right, but now we want to look at the relative importance of direct versus indirect finance. And to do that, we just... All right, so to look at the relative importance, so we're going to divide indirect finance, okay, the amount of indirect finance that went on in the economy through that year, so the provision of finance through indirect finance, by direct finance. And in fact, we're going to see that comes out to 0.71. So the amount of indirect finance compared to the amount of direct finance in the Australian economy in 2010-11 was 71% of the amount of direct finance. So in 2010-11, direct finance was a more important source of finance to the economy than indirect finance. All right. Now, that's been another big change through the years as well. It used to be the case that intermediated finance was more important. But since the GFC, direct finance has become more important than indirect finance for various reasons. All right, so going back to the computer now, I want to have a look at the things that Mishkin has said about intermediated finance in the economy. All right, so these are some of the questions that we have already answered for Australia for 2010-11. How much new financing was direct and how much was intermediated? All right, so we saw that $135.3 billion was intermediated, $189.9 billion was direct finance. Which sectors were in deficit and which sectors were in surplus? Well, we saw how we can use the capital account to have a look at that for 2010-11. We've had a look at how we answer question 3. Do sectors focus on particular markets or financial instruments to raise funds? So, for example, we saw that in 2010-11, the principal way in which business financed its activities was by issuing equity and by issuing long-term shares. And what I haven't done was showing you which sectors were major borrowers of offshore funds. So just going back to this document camera for a minute. All right. So we saw that the rest of the world was a net lender to Australia. That's usually the case. It's usually the case that our foreign debt goes up rather than goes down. And the principal asset that the rest of the world acquired was long-term securities other than shares. All right. So the principal asset that the rest of the world bought from Australia were long-term bonds. All right, which sectors issued those long-term bonds? Okay, so which sectors borrowed from the rest of the world by issuing long-term bonds? Well, we have to look down at the liabilities then. All right, if someone's issued a long-term bond, then it's borrowing money. All right, so which were the sectors that actually made the largest issues of long-term bonds? Well, going down to the liabilities section, looking at the row, long-term securities other than shares, we can see that the government sector was the major borrower from overseas in 2010-11. All right, so the government sector was in deficit. How did it finance its deficit? It largely financed its deficit by issuing long-term bonds to overseas investors. All right, so that's some information that we can get out of the flow of funds statement. And the other major borrower through the issuer of long-term bonds was the business sector. We can see that the business sector issued $21.3 billion worth of bonds, and so it looks like they borrowed a lot of money by issuing bonds to overseas investors as well. All right, so we can use the flow of funds statement to answer that fourth question as well. Oh, sorry. I haven't quite finished. I just want to... All right. No. All right. We'll finish very quickly, but please be quiet so I can actually talk over you. Now, there's a chapter in Mishkin I've asked you to read. Okay, it sort of comes after he's talked about the importance of intermediated financing. And he's written these 8 basic facts. Stocks are not the most... I'm losing my voice, so please take pity on me. I only want a few more minutes. Stocks are not the most important source of external financing for businesses. Well, what did we say in our flow of funds? What was the principal way in which they financed activities in 2010-11? They issued equity. All right, so Mishkin's got it wrong for Australia there. Issuing marketable debt and equity securities is not the primary way in which businesses finance their operations. Well, if you add up the equity plus the long-term debt securities, plus the short-term debt securities in the liabilities account for the incurrence of liabilities by the business sector, guess what? It is the major way in which businesses finance their operations in 2010-11 in Australia. So Mishkin's got it wrong there for Australia as well. So 3, his third point, indirect finance is many times more important than direct finance. Well, in fact, we've just seen that in 2010-11, direct finance was more important than indirect finance for Australia in 2010-11. All right, indirect finance was only 0.71 times the amount of direct finance. And the fourth point there is that financial intermediaries are the most important source of external funds used to finance business. Well, again, that's wrong for Australia in 2010-11. So, as I said before, you need to sometimes read textbooks with a critical eye. All right, here, Mishkin sort of says this is true for most advanced countries, but when you start actually looking at flow of funds statements, particularly for Australia, some of these things are true in some years, have been true for some years in the past, but they're not going to stay true throughout history. And the GFC has really changed financing flows quite dramatically in Australia. So, as I said, sort of, read some things with a bit of a critical eye. We've seen with the flow of funds statements how we can actually counter these first 4 points. The last 4 points are true, all right? They're just general facts. And it's certainly true that the financial system is heavily regulated. It's certainly true that only large corporations basically have access to securities markets. Collateral is a prevalent feature of debt contracts. And the last one just talks about debt contracts being complicated legal documents that place restrictive covenants on borrowers. That's true as well. All right. So next week we're going to have a look at commercial banking and some of the risks that banks face using a return on equity framework.